Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 20 minutes. Today, we're going to have a shortened version of Options Guide TV. This week, we had kind of a slow week as far as earnings are concerned. There were some that were kind of interesting to look at. Next week, though, we have it's all about the retail consumer. We have Home Depot announcing next week, Walmart, which I think is going to be a real interesting one to see where Walmart's going. They've been making some strides recently. And then we have Target, we have TJ Maxx. So we're going to get a really good picture of the retail consumer going into the big holiday shopping season. So we'll do a couple of speculative trades next week on some of those retailers. Probably on Monday, we'll look at Home Depot. And once again, on Options Guide TV, it's all about how to use different plays inside the Options Playbook to try to take advantage of market conditions. It's all about trying to learn. Nothing's meant to be a recommendation in general. Use what we do on the show and apply it to the stocks that you want to trade. So around earnings, you learned a lot about option pricing. So we're going to come back next week. We're going to do a few more speculative trades, and then we're going to probably add one of these retailers to our fig leaf portfolio. And I've decided to call it the fig leaf portfolio right now. But what it really is we're buying deep in the money option contracts as a substitute for owning the stock outright. Now, inside my own portfolio of stocks, I have always from time to time bought deep in the money options as an alternative to buying the stock. There are issues with buying deep in the money options in that the bid-ask spread on them are usually much wider than they would be on the underlying stock. And that's one battle that you have to deal with. So you do want to pick liquid underlyings. We're going to try to add about 5, maybe 7, if I get a little frisky, different stocks that we're going to try to follow throughout the 2020 year. And we're going to then take that portfolio and we're going to continue to sell calls against those deep in the money option contracts. And when we're doing that, we're going to adjust that portfolio and just kind of see how that does relative to maybe a stock portfolio. We're going to be managing this inside the paper trading app. So we don't have all the quotes that we would normally have. Today, the market is a little bit mixed. We're not really seeing, the market has been driven recently by, and I'll just bring up the SPY to kind of show you that. Once again, I can't get SPX and different things like that, but we're kind of flat today, up $1.38. It looks like 1/3% in the SPY. The VIX is just kind of hanging out right around that 15 level. And the biggest thing that we've seen, though, is we had an auction in the 10-year. After that, during that auction, we saw interest rates go up a little bit. But after that, we've actually seen them kind of drop off. We see the 10-year at 4.6%. Talked a couple of times over the last week on Options Guide TV about the fact that the Fed now in the January 31st meeting or announcement, that's usually that's the day that they should be announcing, the Fed funds future over on the CME, the Chicago Mercantile Exchange, that tool is showing that there's only, at this point in time for January 1st, there's a 19.4% hike, a possibility of a 1/4% hike in the Fed funds rate. But you go out to March, the March 20th meeting, and they're showing a 14% chance of a cut in interest rates. That's a real number. And that was 20% just, I think it was on Wednesday when we did the show. I think it was right around 20%. So it's kind of came down a little bit, but they're just saying that there's a chance that early next year, the Fed might actually start cutting rates. And I think the 10-year is following along with that narrative. We ran up to the 5%. The market really got hurt by that. Obviously, we've got a lot of geopolitical concerns. The debt crisis is still a big issue. Still have issues in government trying to fund the government. There's still going to be a big event that has to happen with budget talks and everything else with that. So we still got a lot of landmines out there, and usually you do, right? The world's a pretty big place, and there's usually something going on somewhere. But the 10 years seems to be the biggest driver of the markets at this point in time. And once again, we see the SPX trading around the 4,300 level. We came down below the 4,200. That was a scary range, bounced back up. We actually did a long straddle in the Russell 2000. Actually, kind of curious where that's at. I haven't looked at that yet today. We see the IWM. Is that going to be up a little bit today? No, that's flat. But we did get a bounce. We got a strong move up. We're able to sell our call for a profit. And on last week's show, we actually just tapped out on the put and we sold that for about 50 cents. Very solid trade in a couple of weeks. And that was all based off of the IWM chart. That's the main reason why we thought about doing a long straddle. So today, let me reiterate. On Wednesday, we went back in and I'm going to show you the paper trading portfolio. I don't have as big of a screen because I am traveling this week. I'll be back on Monday in my in my normal studio, I should say. So we went in, we decided we're going to buy some Caterpillar, and we bought a deep in the money call option on Caterpillar. And then on Wednesday's show, we sold the we sold the November 24th expiration call option. And then we did that in Google and we did that in NVIDIA. So now I want to add a financial. And after the retail earnings next week, I want to add a retailer. So we're going to try to find the cream of the crop in the retail space that has really liquid option contracts. And we're going to try to buy a deep in the money option contract on one of those retailers after they announce earnings. So now we're going in, we're looking at the options grid. I only have the call options up here, and we're going to go all the way out, and we're going to try to deal with this one expiration too. So we're going to go out to the January contract of 2024. So there's December, January. There we go. So this is the January 19th expiration. Let's click on that. That's 2024. We got to keep going. 1 second. Let me get all the way. I thought I was there, but I guess I'm not. Here we go. All right. So this is January 2025. And we're going to go deep into money, and we're going to look at buying an option contract that has a delta that's right around 80. So if we look at the 150, and this is IWM. Got it. 1 second here. SCHW. What happens when I go on a tangent? So we still got the right expiration. That's great. We still got the delta trading here right around 80%. We're going to look at around the 45 strike call option here. And here we have the bid and we have the ask, and that's trading for around $14. It's a $53 stock. And this isn't a bad bid-ask spread. So we're 14.15 by 14.35. So a 20-cent wide spread, even though that is extremely large on an underlying stock, that's not bad for a deep in the money option contract. So I'm going to go on in and enter this trade. And I apologize, my head's probably going to be in the way down here. But let me go in and click on the asking price of the 45 strike call. Once we do that, that's going to put that in our order ticket. And I apologize that I'm covering it a little bit. But with that said, I'll just read it out. And this is going to be our paper trade for the week. And then once this executes, we're going to go in and try to look at selling a call against that position. So to start with, we are buying the January 2025 expiration, January 17th, 2025 expiration, 45 strike call. We're going to buy this at a limit price. Well, we're going to be in the paper trade account. So let's go and move this to 1440. Which is close to the ask. Maybe we'll do 30. Yeah, we'll do 40. Then we can execute the short call. And we're going to be sending this to the floor inside our paper trading account. we're putting up $14.40 as opposed to buying 100 shares of the stock outright, which would be $5,300. We're going to be spending $1,400 on this position. So when we look at this entire trade relative to this, we're going to be putting up a minimum amount for our position on Schwab, and then we're going to be selling some call against it to try to eat away at the time premium that we had to buy for this deep in the money option contract. So let me hit send on this. And here we are, send order for long call, Schwab 45 with that expiration date, and boom, order is sent. All right. Order has been sent successfully. And if we look at the events, it will tell us if we are filled, and we are filled. So right now, I can kind of see it a little bit. Yep, there it is. So we showed that we filled at $14.40. I might have tried to work it a little bit, but I wanted to get the execution. And now let's go back to the order tickets. We'll put that back up. And we'll look at selling a nearer term option contract. So we're going to go all the way back to the beginning, and we're going to try to go out about 14 days. So the expiration date that we have on our Caterpillar option contract is the 24th. I think let's just stay there. That just makes it simple for us to be able to adjust these positions. And we're going to want to keep a close eye on it. If any of these option contracts get in the money, we want to adjust them, because the biggest thing about the fig leaf strategy is that you do not want to be assigned on those option contracts. You don't own the stock, so you're going to try to avoid that assignment. Let me move this over a little bit more. And I apologize for the smaller screen, but there's not much I can do while I'm traveling. All right, so here we go, 35 days out. That's too far. What expiration was I saying? The 17th, 7 days away, no 17th. All right, there might not be a ton in this one. We might have to do the 24th, which will be right around the holidays. It's not a bad expiration to do. All right, let's look at what we can get for 7 days out. All right, so we're highlighting where a 1 standard deviation move, that's at 56. Implied volatility is trading around 36. That's not too shabby. Getting a little bit of juice for it. That one is Caterpillar. We did that here. We got good on Google. We got good on NVIDIA. I'm going to have to go out one more week. It's just not enough juice. We're looking at 40 cents on the 56. That's not quite 1 standard deviation away. And then on 57, we're getting 23 cents. Delta's 14 on that. Delta's 24 here. Yeah, let's go out to 14 days. And let's sell the 57 strike. So in this, we're getting 36 cents by 38. The delta's around 20%. That's a fairly high probability. All right. So we're going to do the 58. We're going to sacrifice a little bit of premium. I really want to get something around 40 cents, but I don't want to go out to December, only because it's going to screw up our paper trading portfolio, to be blunt. So let's go in and sell this option contract on the bid. And I think we'll be able to see that order status over there. All right. So that's working, and we're going to get rid of our initial order. And now that we have this position on, and you can see it here inside our paper trading portfolio, here's Charles Schwab. This is going to be our official paper trade that we're going to put on for the week. We're going to go in and sell the November 24th expiration, 2023 strike. We're going to sell this at a limit, good market. We'll try 20. See if we can get filled before the show is over. And here's the send. Okay, send order for short call, which is going to be covered on Schwab, the 58 strike call with the November 24th expiration. And we're going to send that to the floor. And there's our ding. Order sent successfully. So inside our events tab, I think we can kind of see this. I'm checking it out over here. Yep, there you go. There's our limit to try to sell. We have not filled at this point in time. We might adjust that if we have to. Okay, so now what I would like to do is actually run over to the options playbook. So let's pause here just for a second, see where we can go. And I'm going to have to minimize that just a little bit. And here's the fig leaf. So if you have any questions about any of these trades, please let me know. Please put them in the chat box. We got plenty of time today to answer any questions. We want to make this as interactive as possible. If you are on the YouTube platform, you can put them in the chat box and I'll try to address them during the show. Okay, so here's the basis of everything that we've talked about recently on Options Guy TV. October was a scary, well, September and October, we mentioned that there was going to be we thought there was going to be a lot of volatility in the marketplace, and it was a scary marketplace. The market didn't really go anywhere. It battled okay, but it was down months for the market in general. And a lot of times, just seasonally, you see September and October do that. So now going into the holiday season, the market's still scary, but I think this is an interesting marketplace to try to build a paper trading portfolio on deep into money options. We're going to be selling calls against it. That strategy inside the options playbook is called the fig leaf. Now, some people will call it a leverage covered call. I've even heard it called a synthetic covered call, which is wrong, mainly because synthetic implies that you have the exact same risk of a covered call. On a fig leaf, your loss is limited to the premium paid for the deep in the money call option. So synthetically, they are not the same trade, but they are leveraged, and that's not bad. But on the trading floor, it would be called a leaps diagonal trade or a diagonal spread in general. Diagonal means that you're buying further out in time. So if you were looking on the quote boards on the trading floor of the Chicago Board Option Exchange or wherever, whatever exchange you're trading at, back in the day, on the right-hand side would be the longer-term option contracts. On the left-hand side, if you're looking at the board, would be the shorter-term option contracts. So you're literally going diagonally on the quote board. So in my mind, the diagonal spread is really the most accurate name, because that comes back from when options were first traded and what was happening while you were standing in the pits of the trading floor. So we say LEAPS because LEAP stands for long-term equity anticipation security. And that's just a fancy marketing term that the CBOE, which is now CBOE Global Markets, or the Chicago Board Options Exchange is what I prefer to call it. When they announced longer-term options, option contracts that go out over 9 months in time, they came up with this acronym. And this is actually a registered trademark of longer term options. There was really no need to have it, but they decided that they were going to do that, and they were going to trademark it. So that's why we have LEAPS. Now, why did we come up with the name the fig leaf? I've mentioned it a couple of times, but I wanted to show it to you inside the options playbook. We even mentioned it here and gave kudos because we put out some suggestions inside a network of option traders and said, what would be an official name? And I love the username of the person that helped us out. I actually don't know the real name of this person, but it's Weird Uncle Jesse. And Weird Uncle Jesse implied fig leaf, implying that you're kind of covered. And if you read the options guide tips, which I highlighted over here, you kind of get it in that we are covered as far as the brokerage firm is concerned when you talk about a fig leaf, because you have the right to buy the underlying stock at a much lower price than you're going to take on an obligation to sell the underlying stock, right? We're buying long-term deep into money options. We're selling short-term out of the money option contracts. Now, the options guide tips section of the playbook is fairly important. And if you been confused by me saying fig leaves, I finally got an opportunity and some time on the show to get into the minutia of it. But if you ever do get in the money, a big issue with buying the deep into money option contracts is that you don't own the stock. You own the right to buy the stock at a certain price. And being a long-term option contract, that was fairly pricey because you paid a lot of time premium. So if you do get assigned, you're kind of covered. You got to figure out what you want to do. You need to go out and buy the stock and give it up for the assignment. And then if you want out of the position, you would just sell the LEAPS call. But you want to sell that call because there's still a lot of time premium in it. And if you exercise it, because of the assignment, you are then creating a situation where you're giving up a lot of that time premium, especially if it happens in the very short term. So hence the reason when we looked at Charles Schwab, we went out more than one standard deviation. And instead of getting 40 cents for our call option, we only took in 20 cents because we really don't want to be assigned on that trade. So we wanted to go out, sacrifice some premium. We didn't pay as much as we did for the stock, and we'll manage that position accordingly because of that. And it explains it all here in Options Guide Tips. And this gives you a little bit more about the actual name here and where that came from. All right. So at this point in time, I don't see a ton of questions there, and we're almost at time. So here's the fig leaf inside the Options Playbook. We're going to start building out that portfolio. We're going to keep that portfolio going for at least a year. It's a longer term portfolio, and I would even think about, we're going out to 2025. We would probably roll it if we wanted to keep it up and running. And I would filter this in with some of the stocks that I own. A great example is recently, I was long some financial stocks, and one of the stalwarts I always thought in that space, and especially in the brokerage industry space, was Charles Schwab. They keep buying up large brokers and adding them to their portfolio of brokers. They were the company that turned the industry up on their head by going from $5 a trade for stocks to zero. And that's mainly because they're trying to push people into managed products. That's their whole reasoning behind it. And a lot of brokerage, and all the brokerage firms that didn't have a lot of the managed products then sold out to Schwab. So they knew what they were doing. And they're trying to execute on their strategy. And the interest rates and what's going on with the skew between interest rates between the short term and the long term has kind of beaten them up a little bit. They were brought down a lot because of the regional banks, but their cash position is still strong, trading at a measly like 14 times earnings. So they're definitely not overvalued in this marketplace. So I looked at my portfolio that was doing okay in that position, and I added some deep in the money call options because I didn't want to add any more. I don't know. I want to say actual cash, but I didn't want to go any longer on Charles Schwab. But I do think that in this range, over the long term, and long term might be 2 to 3 years, even going into 2024, I don't mind being long some of these stocks. So I decided to do it via a deep in the money option. So I'm long stock. I am long deep in the money options on Charles Schwab, and I'm going to add it to the Options Guy paper trading portfolio. And that's where I'm at. And we are at time. So that's it for this edition of Options Guy TV. If you are on the YouTube platform, please click subscribe, ring the bell so you get all of the notifications for Options Guy TV. And please pound that thumbs up. That really does help us out. And we'll see you this Monday back in my original studio, or my normal studio is a better way to say it, for the next edition of Options Guy TV. Thanks for coming, everyone.